And that's why gold is supplanting the United States dollar as the world's reserve currency. That's a functionality of why we see these record-setting prices for gold, which I think are just starting.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for April 22nd through April 29th, 2025, while supplies last. First this week, we feature 1-ounce silver Canadian maples at their lowest premium in years at just $3.49 over spot. Next, 1-ounce Gold Philharmonics are only $65 over spot. 1 10th-ounce Platinum Britannia are just $29 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. I'm your host, Dunnigan Kaiser, the founder of Liberty and Finance, and today we welcome a returning guest, Michael Pento, an active money manager and the founder of Pento Portfolio Strategies. Joins us this Monday, April 28th, 2025. Michael, thank you for coming back on Liberty and Finance.
Always a pleasure, Dunnigan. Looking very dapper over there today.
As you always are. And we are always looking forward to your weekly updates. You call them midweek reality checks, and I always like to think of them as midweek sanity checks. You try to keep us and your subscribers and your clients on the right side of what's coming next in the financial lives by looking at forward indicators. Two particular things we'd really like to cover with you today. One is the real estate market. The other is the equities, the stock market. And both in the context of the changes that are happening, swirling around us in our financial lives. You can take those in either order, whichever you'd rather take first, and let us know what the likelihood of changes in those areas are based on the forward-looking indicators that you're following. So either the real estate market or the major stock market indices that people are heavily subject to. The reason we bring this up is just because so many of the retirement age and late career stage age subscribers of our channel are dependent on those assets classes to be a significant portion of their future. And there seems to be big changes roiling in both of those areas. If you could bring us up to date.
Yeah, so let's start with let's take the stock market first. So I think we're down, as of this morning, I think the S&P was down about 6% on the year after falling about 15%. So we've had a nice rally back. I am completely miffed as to why this is occurring, because I think we are about 3 to 4 weeks away from seeing significant supply shortages on the shelves. If you listen to the importers, 60% of global transportation via vessel is down. 60%, 60. Now China's our second largest exporter. They export about almost $500 billion of goods to the United States per annum, and they're down 60%. So not only that, you've got price hikes in the hundreds of percentiles in retailers. Retailers are scrambling to supplant these sources. They can't find adequate suppliers. So you're looking at layoffs, business closures, empty shelves in a matter of weeks, and yet the stock market is presaging nirvana. So this is remarkable, Dunnigan. I did some work this weekend. The S&P 500 is still presaging 9% earnings per share growth in 2025. And it's already slapped a 21 times multiple on 9% earnings growth, which is for those who are unaware, 21 times earnings is several times higher. I mean, the average is around 18% earnings. Yeah, 18 times earnings. We're 21 times a fantasy 9% earnings growth. How do you get 9% earnings growth, Dunnigan, when economic growth is shrinking by 2.5%, according to not Dunnigan, Kaiser, or Michael Pento, according to the Atlanta Fed, Q1, GDP growth is shrinking at 2.5%, and you have margin compression from tariffs. How do you get earnings growth of 9%? But even if everything works out well, we are going to see what we see now, the S&P 500 around 5,600. That's the best you can get. And I think that's the assumption comes from decades of inculcation that, hey, the stock market will always go up because either the Fed is going to print money or the government is going to borrow money. So, let's just real quick, after the NASDAQ bubble collapse, what happened? The government borrowed trillions of dollars and the Fed printed it. After the housing market crashed, same thing happened. After the COVID pandemic breaks out, what happens? The market crashes and the Fed monetizes $5 trillion worth of the $6 trillion in COVID spending, helicopter money and mortgage forbearances and all the other things that we went through. So they're looking for an imminent rescue from the Federal Reserve and from the Treasury. It just is not possible to happen at this time. Not with inflation way above their target. The Fed is not inclined to go through any kind of QE or any kind of massive reduction in interest rates anytime soon. And the Treasury at best is going to pass the extension of the TCJA, which is the Trump's the Tax Cut and Jobs Act, which is status quo as far as taxes are concerned. So I think the market is a sell here. I'm not saying it's going to crash, but I certainly wouldn't be chasing this market here. That's the answer to your first question. And I'll let you back in because I know you're...
Well, I just think one of the most fascinating parts of what you just described, there's two clusters of interest I have there. One is all these facts that you laid out that demonstrate how grave the situation is in contrast to what we call the great financial crisis or the global financial collapse of 2007 and 8 and 9. The other is the psychological aspect, the denial it seems to be an engineered and institutionalized denial, not just random human nature type denial, but it seems like it's a thing that's out there, just like we had other types of mass formation psychoses that happened over the past 4 years. We seem to be having this mass formation psychosis of denial, just whistling past the graveyard. And that usually doesn't end well for those who are in denial. Can you maybe, before we move on to it's going to come up again. I know it's going to come up again when we talk about the real estate market. So maybe we should do that and then get to this point about people having been lulled to sleep psychologically and why that means they're not taking effective action right now. Right. So, but if you want to comment on that, fine. Otherwise, you want to defer that to after we talk about real estate.
Just a couple of quick comments on real estate. The COVID wave, let's just talk about where everybody moved post-COVID, which was Texas and Florida and North Carolina. For two reasons. Was the technology was there. Hey, you can't go to your office and you could work remotely. So I was like, listen, I can work remotely. Why am I living in this, very expensive, dirty, highly overpopulated city? Why don't
Authoritarian.
Right. Well, I'm getting to that.
Okay, go ahead.
Part of that was also, and by the way, your kid has to learn remotely, and the schools are closed, and your businesses are closed. So people flooded to Florida and Texas and North Carolina. Those are the states that had the most recipients. So the COVID wave is over, and what's changed in just a few years is instead of mortgage rates being high 2s, low 3s, they're now close to 7-8% now again. So they were 7%, not 8. Let's not use hyperbole. They're headed to 8 in my opinion, but they're not 2, 3, they're 7% now, because long-term rates are much higher. In the 10-year, that's what mortgage rates are based off of. So you have much higher borrowing costs. The COVID wave is over, and inventory is now up 30% nationally. 30% in inventory for homes for sale. Days on market is the highest in a very long time, in years. The month supply of home is the highest it's been in years. So what you're seeing now is the most price reductions we've ever seen in history. Home price reductions are the highest they've ever been in history. So you're going to see, instead of, well, my home is going up 10, 20% per annum, and my portfolio is going up 20% per annum, what you're seeing is the exact opposite. My portfolio is down and my home price is rolling over. And that has massive implications for those who have investment home properties, which is like 25% of individuals. All 20 to 25% of all homes are now investor owned. That's either institutional ownership or individual ownership of investment homes. The calculation is very simple. If the home that I'm renting out has a problem with the income stream, where the renter is no longer paying me rent because he lost his job, his or her job, and the home price is starting to fall, why am I paying taxes on this house? Why am I paying mortgage interest? Why am I paying maintenance and insurance? Why am I doing all that?
An association fee.
Yes. So it's very easy to sell your house that's an investment property. You just call your broker and put it up for sale. It's not like you have to worry about moving costs or changing addresses and all that. And it's none of that's involved. So I think the inventory is going to spike even further from here. So the reverse wealth effect is going to be extremely salient.
Among those who are listing their homes close to us, some have quickly taken them off the market even after cutting prices, thinking, okay, well, it's not ideal time right now because there's a glut of home building going on around us, or there's others who are trying to sell right now. So back to your first side of the record that we were playing earlier, as the market always bounces back, it'll surely bounce back. So I'll just wait 6 months or wait 9 months or wait a year, and then we'll be in another one of these upswings in the market, and I'll put my house back on the market a year from now. What are the flawed assumptions in that model?
Well, they've been inculcated through decades that, hey, I just wait for the Fed to cut interest rates to zero, and then borrowing costs come down, and then it'll reflate the asset prices. I think the major flaw here, Dunnigan, could be that, which I didn't talk about before, which I was going to get to, is that when you have these iterations of crises, either recessions or a real estate bubble or a pandemic, and you attack them because you have a fiat currency, you have a tool that you have, it's called the printing press. You abuse two things, so you end up becoming an insolvent nation. And you no longer have a problem with deflation or disinflation, you have a problem with inflation. So now we have an insolvent nation and we have problems with inflation. So when you cut interest rates and go back to ZIRP and QE and spend more money on top of your insolvent condition, what happens is that long-term interest rates might rise, or at the very least not fall very much, as opposed to just following the Fed back towards zero. So you're going to get no relief in the mortgage market. You could actually have a huge problem in the mortgage market as mortgage borrowing costs spike instead of fall, as they usually do in recessions.
Can you please describe the mechanism of that? Because I think that's very valuable for our viewers to understand that the Fed can't control the long end of the curve as directly as they can the short end of the curve, and there are other market forces that drive that.
Right. So the Fed controls something called the Fed funds interest rate, which is the overnight interbank lending rate, which is what banks borrow from each other. And that's called the money market rate. And short-term interest rates, T-bills, compete with the money market rate. So the Fed controls that very easily, unless they're engaged in quantitative easing, which is direct purchase of long-term Treasury bonds. And they have to be very aggressive on that front. An indiscriminate buyer of trillions of dollars of Treasury debt, which in itself has a massive inflation implication, then you cannot say that the Fed controls the whole yield curve dynamic. They control only the short end. And then you have to ask yourself, well, okay, Mr. Pento, what if the Fed assents to the notion of printing trillions of dollars to engage in QE to just bend down the long end of the yield curve? Well, my retort would be, are they going to buy mortgage-backed securities too? Are they also going to buy commercial paper? Are they going to buy corporate debt as well? Are they going to buy municipal bonds too? I mean, how much debt are they willing to really buy? Because you're going to have a huge problem in the economy. Is the Fed going to supplant the entire bond market, public and private sector? I mean, then you're talking about Zimbabwe. So I don't think they're going to do that. So I certainly wouldn't do it unless there was a massive issue in the economy. You're talking about a depression where both the money market, short-term rates and long-term rates were completely frozen. Repo market frozen. All types of debt was frozen, and they were the only buyer. And we're not there yet.
You mentioned about half a dozen factors there. In addition to that, you didn't mention, I believe, is foreign sellers of Treasury bonds. We're told that in Q1, China dumped like $50 billion in U.S. Treasuries. Can you talk to us about that additional puddle that would need to be mopped up, or that river or lake or typhoon or whatever it would be?
So, China is one thing. You're right about that. I mean, I want to talk about supplanting demand for our Treasury bond market. What about Japan? Japan is the largest holder of our Treasuries, and Japan for a very, very long time, their long-term rates were 1/4%, less than 1/4% on long duration Japanese JGBs going out 10 years. And now they're close to 1.5. So they have a viable alternative. But then you have to also talk about the trade war, which spiked really the blow up in the bond market. Just think about this. There's two functions here. If global trade grinds to a halt, let's just say there's no longer a huge trade surplus for Japan and China to recycle into our bond market and currency. If that goes away, the bid for our treasuries attenuates significantly. And then you also think about what happened with Russia and these arbitrary, capricious sanctions that we impose on countries. Say, listen, your savings is no longer yours. We're going to confiscate that for you. That started the belief that, hey, what if China is going to have a trillion, I think it's about 750, $800 billion of their sovereign wealth parked into U.S. Treasury debt, and Japan owns $1 trillion, or whatever is a problem, the United States no longer thinks that that they are our friend. I think you can ask Canada about that. What did Canada do to us? Suddenly, Canada, there's a lot of antipathy between the U.S. and Canada. Well, what happens if, for some reason, some administration says, you know what, your sovereign wealth is now ours. We're going to freeze your assets. Does it make a lot of sense to hold a lot of your wealth, your nation's wealth, in another nation that has such fickle behavior? So that, and the fact that there's no longer that big trade surplus to recycle into treasuries, it's a big, big dent in the demand for U.S. treasuries. And you take that, you say, well, okay, if I'm going to sell treasuries and then I'm going to sell dollars, but I don't want my currency to rise, what do I do instead? I sell treasuries, sell the dollar-denominated treasuries, and buy gold. And that's why gold is supplanting the United States dollar as the world's reserve currency. That's a functionality of why we see these record-setting prices for gold, which I think are just starting.
You've talked about, we were talking about denial on the part of individual homeowners who assume that the Fed has always got their back and will always cause a rebound after any dip in either the stock markets or the real estate market. So if you want to touch on that, that's fine. And then can we broaden that into institutional shepherds of funds for pension plans, municipal endowments, et cetera, who may be in the same psychological trap that the individuals are, thinking that the Fed's always got their back and you're always going to rebound. So just hold tight and just sail the ship the same way you've been sailing for the past 40 years. You'll be fine.
I think the way it's going to work, Don, again, unfortunately, the way it has worked for many, many years now is you have a job and you fund your 401k. And your 401k closet index the S&P 500, and the S&P 500 goes, it's just an indiscriminate buyer of every paycheck, as the fund flows are incredible towards the S&P 500. And you have the highest valued, because it's a market cap weighted index, get you have something called the Mag 7, where you have them equal 40% of the entire index. It's just a function of math and the flow of funds. What I think is going to happen this time around, as we enter into a recession, which I'm almost 100% sure that we're going to see one this year, not sometime this year. We're already halfway there. Q1 is going to be profoundly negative. I would be surprised if it doesn't get even worse in Q2, unless we see an immediate cessation of the tariff conflagration, and we can get into that in a second. But I mean, it's hard for me to come up with a scenario where you're going to have a deal when one side of the argument doesn't even acknowledge the fact that we were having a discussion. So we're going to have a recession, and it might not be that deep, but it's hard for me to make an argument that you can see a flood of buyers for houses and a flood of buying into stocks, because this is, so as I can just finish my thought. So people start getting laid off. They stop funding their 401k when that happens. The market dies 30% or more, 40%. Then finally you get the attention of the individual investor, who is the only one really buying this market right now. The individual investors have never stopped. They have been so surely inculcated to buy every dip because the Fed and Treasury have your back, that they're just dying. This is like an opportunity for them just to, hey, buy every dip. And we can get into a reason why that's not going to work in a second. But so if I can just finish. So unemployment rate spikes, the market drops, the flow of funds into the S&P 500 dry up, and then you get the people who are employed always panic at the nadir of any bear market. They call up and panic and say, hey, they call the plan administrator and say, just get me out of my current S&P 500 fund. I want to go into cash. And then it goes from a 35% drop down to 50% drop. That's when you maybe start getting interest. That's when you see the buying. When you have forced liquidations of hedge funds and forced liquidations of funds in the shadow banking system, you could pick up some really good bargains. I think that's where we're headed, because I don't see any other way around it, unless you see a significant reduction in interest rates ahead of this, which is not going to happen. Unless you see QE happening very soon, it's not going to happen. In fact, they're still into a very mild version of QT. And unless all tariffs that were imposed from Liberation Day go to zero, not 10, zero, I think you're going to have a very difficult time. Because don't forget, I'm sorry, I know I'm long-winded, but this market was in trouble. The economic situation was in trouble ahead of the tariffs because of the fact that the labor force was shrinking. And the fact that, thankfully, the government was stopping all their hiring. The government was doing all of the hiring. It was government and government contractors. That's why you say every month the non-farm payroll report was gangbusters, because 70% of them was a derivative of what government was doing. That stopped. So you have those two things happening. That's not a recession, but just means there's no growth in the economy. And when you add tariffs onto that, you get a recession.
So in addition to these primary factors of the market already being unhealthy, the GDP already not growing other than what was being directly sponsored by the government, employment, et cetera, you mentioned that along the way, you're not going to expect a bounce back from the initial or second pullback due to some additional factors. What are those factors?
Well, we have reached, in my opinion, and I've been doing this for 34 years now, so it's not an unlearned opinion. It's one that I've formed from doing this job for decades. I think that we have reached our government's ability to borrow trillions of dollars and have the Fed monetize that deficit and debt without engendering intractable inflation and spiking long-term bond yields. That is the short answer.
Is that partly because of the loss of confidence, both of foreign bondholders? Because you mentioned about the retail buyers of stocks are the last ones to give up to abandon their post long after the insiders and so on have already left the ship and they're off on the lifeboats and the the golden lifeboats or whatever lifeboats they have, and it was the dutiful retail investors that stood at their post and kept buying with their 401ks along the way. What are the factors that cause this phenomenon that you're describing?
Well, the factor is that the fear and greed. It's just a matter of fear and greed. That's how the private sector behaves. So they get most fearful at the bottom of the market. That's just history. And they get most greedy at tops of markets. This is what's happening today, Dunnigan. I am shocked that when I'm reading reports from imports. I mean, these are reports from people who actually are involved in shipping, global shipping, are saying, hey, this is going to be a disaster. Exports from the U.S. to China, pork exports are down some 30%. China has stopped buying many products from retailers here in the United States. Layoffs are happening right now from small businesses. They cannot stay in business when they import most of their goods from China and have to pay 145% duty. They cannot keep the store shelves stocked, so there is no business. So the business lays off. First, they lay off their employees, and then they close down. This is happening right now. I am absolutely shocked as we record this on Monday morning that the market isn't really tanking. It should be for this market to reach fair value based on my estimations. It should be closer to the S&P 500 should be closer to 4,000 rather than 5,600.
Michael, you put out a lot of publications, at least weekly, on this and other topics to keep people looking ahead and seeing. As you point out, the Fed always reacts too late. They're always looking at trailing indicators. They always say, yeah, if the economy is strong, employment is strong, blah, 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 consumer is strong, until it becomes undeniable that it's too late to say that anymore. And they go, I guess we should start doing some little minor adjustments, just minor adjustments. Right. Okay, for people who don't want to wait for the Fed to have their back, if that's even doable at this case, you said we've reached maximum debt saturation, et cetera. How can people stay connected with your latest thinking so that they make their moves ahead of that?
Well, you can subscribe to my podcast called The Midweek Reality Check. It's $50 a year, and it's a 5-week free trial. And I'll give you all the salient data that I talk about on your program about, for the pork exports, for example. And if you are a U.S. citizen and you have $100,000 and you are suitable for the portfolio, I will manage your money personally in the inflation, deflation, and economic cycle model, which actually, saved us from this. It tends to, in the past, and that's not guarantee of future results, but it looks at the arcane components of the market that let me know when the real big boy, the insiders that control hundreds of billions of dollars, are understanding that there's going to be a problem in the economy or the credit markets, and they act first. And that's what this model is built to pick up on. And it does, and it did. So, and it also does the opposite. At the bottom of the market, when everybody's panicking, it says, wait a second, his credit spreads are starting to narrow again, and financial conditions are starting to ease. The ones that I look at, the salient ones, I'm not going to get the day, I can guarantee you that. But it recognizes big turns in the economy. Because as you know, I've been with you for many years. I am almost always bearish on the construction of the United States economy, and indeed most of the developed world, which is predicated on debt and monetization of that debt. But am I always bearish on equities? Not at all. Many times, and most of the time, I'm actually optimistic, but on what sectors and what part of the yield curve and what commodities and what currencies? That's the question that I ask. So that's what the inflation, deflation, economic cycle model is built to do.
Well, with your help, we hopefully won't be whistling past the graveyard, but have eyes wide open and make the right moves ahead of that. And we're grateful, as always, for your presence here on Liberty and Finance. And folks, only half of our viewers are subscribers. So that means half of you are missing out on free notifications you could get from YouTube for one. You can just click the subscribe button and click the little bell and you'll get notified. But for all of ours who may be watching us on other platforms as well, just get on our free mailing list, and it's completely private. Just go to our website, libertyandfinance.com, libertyandfinance.com, spelled out. Put your email address and click submit. Make sure you confirm on the confirming email, and you'll get 1 email in your inbox per day. We won't share your email with anyone. It's completely private, completely free, and you won't miss a single episode with Michael Pento or any of our other guests or any weekly specials. And so as always, Michael, thank you for joining us here on Liberty and Finance.
My pleasure, Dunnigan.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for April 22nd through April 29th, 2025, while supplies last. First this week, we feature 1-ounce silver Canadian maples at their lowest premium in years at just $3.49 over spot. Next, 1-ounce Gold Philharmonics are only $65 over spot. 1 10th-ounce Platinum Britannia are just $29 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.